Welcome to my daily report market analysis videos with me, Richard Perry, market analyst at Hantec on Wednesday, the 18th of March. Well, there was an enormous round of fiscal stimulus that we saw throughout major economies of the world yesterday. We had moves from France, from Spain, from the UK, and also from the United States. Massive fiscal support for the economies, given how the economic impact of coronavirus is yet to be known, really, but they obviously know that it's not going to be great. And subsequently, we're seeing around about 15% of GDP of fiscal stimulus on the European economies of France, Spain, and the UK. And the US is engaging in a massive 850 billion, maybe even over $1 trillion worth of fiscal support in the US there. So what we have seen, a sharp moves higher actually in Treasury yields. So that's the 2-year. That's not where you're seeing the sharp moves higher in Treasury yields, and that's fairly much replicated across the board on bond yields. We've got Treasury yield sharply higher, back above 1%. Look at the German Bund yield, 0.24% negative. You've got in the UK a massive increase as well in the 10-year yield. So these bond yields are all responding higher as these fiscal programs have been announced. And what we're looking at is how the markets are responding, broadly speaking, to these moves. And yesterday was positive, but again, today we're back lower. S&P 500, 6% higher yesterday. Look at the futures, up towards 4% lower. But look at these European markets, all 4 to 5% lower on FTSE, DAX, and CAC. So really isn't doing all that well. Interesting that correlation between equity markets and commodities continues to show through. That gold price. Why is gold falling as the equity markets are under huge pressure? Well, we still sort of see that phenomenon of margin calls and liquidations certainly being negative for gold. And that continues to play a role there in the price. But what we've seen today is a degree of I'm going to say a degree of stabilization. It looked earlier as though that the dollar was starting to sort of just steady a little bit, but into the European session, as more sort of things have got going, the dollar has started to drag euro dollar back. Cable is back again around that 120 big figure, not too far off that, and dollar yen also starting to fall away again. Pretty much the commodity currencies are the ones under the biggest pressure at the moment. The Canadian, Aussie, and Kiwi dollars all under water there. So we see this as the commodity prices are all falling. Look at that oil price, 25.59. Now, well, I mean, that for me is not very good news at all. 26.05 was the reaction low from February 2016. Let me just go all the way back to 2003, to the last time we were at this sort of level, that reaction low. Let me change that. 26.05 was that 2016 low, and we're basically underneath that now. So just multi-year lows on oil now. Incredible. So no real let up in the selling pressure through commodities as yet. In terms of what we can look forward to maybe on the data front, yeah, there's not a great deal. We've got final Eurozone inflation data. You've got building permits and housing starts from the States, but again, you're not really expecting to see these changing the picture. And data matters nothing at the moment. If anything, it paints an even worse picture, because when the consumer data comes out, such as retail sales did, or the German ZEW the other day, it just absolutely tanks and shows how poorly these economies are all going to be performing in the months ahead. So we've also got the oh, sorry, that's wrong. We'll go back there. We've also got the inventories for crude oil today. Now, crude oil inventories are expected to once more show an inventory build. So again, that's not going to be helping that oil price. We've now actually been in an inventory build scenario for the EIA for the last 8 weeks. And it looks like it's going to be another week of inventory building. So stocks piles continue to grow, and that's never going to be great for the oil price really there. Now, one other point I would make is we were due to have a Fed meeting today. Fed meeting, obviously, given the actions of the Federal Reserve over the weekend and the enormous package of easing measures they engaged, we're not going to be having a Fed meeting, an FOMC meeting today. We're now looking at the end of April as the next meeting. Okay, so let's have a look at my chart of the day, which is the Aussie Kiwi. Now, this is really interesting because obviously both these Aussie and Kiwi are commodity currencies, and the Aussie has certainly been hit hard, and you can see the reflection of that through the past couple of weeks, where against the Kiwi, Aussie has lost upwards of 5%. So an incredible decline on the Aussie versus the Kiwi. But are we on the brink of a turnaround? We've seen that. I talked yesterday about, I talked in the daily report about parity. Now, parity has never been seen on my charts anyway, across Aussie Kiwi. And those charts go back to 1980. So it's never been at parity. 1007 was yesterday's low. Again, picking up from there. Now, this is interesting because it's sort of, if I zoom out slightly here, you can see that that level was touched 10015 back in 2015. And again, it's sort of come back to that level. But intraday has rebounded and rebounded quite positively. Look at this. Before I sort of think about the potential of a recovery, you can see that we've got the momentum indicators really picking up now. 62 on the hourly RSI. That is the best level on the RSI. If I put my crosshair on around about 50, 55. Best level seen since, well, certainly since the selling pressure really began a couple of weeks ago. So is this a turnaround moment? You can see the falling 89-hour moving average provided resistance a couple of days ago. But this is a really interesting moment, I think, for Aussie Kiwi. Is this a turnaround? Because you can see the improvement in momentum indicators on the hourly chart starting to reflect through on the daily chart as well. That RSI picking up. 27 isn't yet a confirmed signal by any means. But what you can see on this is the prospect of a bull cross above 30 on the RSI on the daily. Potential for, I suppose, moves on the stochastics as well. But if you see on the hourly chart, old support becomes new resistance on Aussie Kiwi. It's done that for the past, well, for a while actually. I mean, I could even have more examples of this, where you see, get across here, old support becoming new resistance. And you can see that again a few days ago, but 103, 102.20 and 101.30 have all been instances of that. But breaking above 101.30, if you can hold that break this morning, well, that is an improvement. Certainly into the close today, that would be a positive candle, which again, we have had a run of, I think, 8 or 9 bearish candles. So is this the prospect of a turnaround, given the fact that parity is such a crucial low on Aussie Kiwi? So really interesting moments here for Australian dollar versus the Kiwi. So with that in mind, I wish you good luck in your trading today. Click here to subscribe to our analysis videos and go to our website to sign up for our webinars.